All right, hey everyone, this is Scott here again with my next live trading video. Today is Wednesday, April 20th, and in this one here, we'll be talking exclusively about Netflix, and in particular, how I'll be trading the stock going forward after their disastrous earnings announcement yesterday. So as you can see down here with this little icon, this represents their earnings announcement where they actually beat expectations in terms of earnings per share, but overall, their subscriber count definitely disappointed. So basically, this is the first time in about 10 years, I believe, where Netflix has actually lost subscribers. And as a result of that, currently the stock is down by almost 40%. And also do keep in mind, this is on the heels of another terrible earnings announcement that happened previously to this one, which looks like back in January of this year. And as you can see, a very similar story. In this case here, Netflix dropped by about 30+%. So ultimately here, coming down from a high of just over $700 per share down to a low, at least so far, of 212, that's a decline of about 70%. That's a massive, massive number for a huge company like Netflix. And moreover, to give you a few more details, let's come over to this Yahoo Finance page. As you can see, the title here is Netflix stock crashes. Definitely not an exaggeration. And the main things that I look for during an earnings announcement are the actual numbers themselves. For example, revenue, earnings per share, and in the case of Netflix, what was their growth, or in this case, decline of their subscribers. So in terms of revenue, you can see their actual revenue was $7.87 billion versus an expected amount of $7.95 billion. So they did miss the mark by a tiny bit on the revenue. And then on earnings per share, as I showed you on the charts, they actually beat expectations, right? $3.53 versus an expected amount of $2.91 per share. And then the main disappointment was their net subscribers, minus 200,000 over this past quarter versus an expected amount of a gain in 2.51 million. So obviously that is a huge miss there, but overall year over year, Netflix has gained about 4 million subscribers. So basically on a more macro scale, year over year, Netflix is still growing rather significantly. And so ultimately, my personal opinion here on the matter is that, even with these massive blue chip companies like Netflix, Apple, Google, Facebook, etc., you can't expect these companies to perform perfectly or to have growth every single quarter into perpetuity. At some point, even these kinds of companies are going to falter. And especially for companies that are using a subscription-based model like Netflix here, at some point you're going to saturate the market. And as a result, it's going to get increasingly more difficult to gain more and more subscribers at a consistent rate. So I personally am not surprised to see Netflix's subscriber count finally hit a plateau, perhaps at least for the short term. So the main things I look at when I'm trying to figure out if I want to invest in a company for the longer term is I look at things like the revenue and the profits. And as I just showed you there on the Yahoo Finance page, Netflix has definitely not missed the mark by much on those two numbers. So does that warrant a decline in the stock price by 70%? I personally think that's a bit too much. And so that's why for the foreseeable future here, I'll be trading the wheel strategy on Netflix. And I've actually already gone ahead and made my trade entry, and I'll review that with you here in a second and also explain exactly why I chose the wheel strategy over anything else. But as always, before we dive in here, in case you are brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, so first off here, I'll show you exactly what I did to make this trade. So we'll come over to the trade tab and go into the May expiration cycle with 30 days left to go. We'll unfold that tab. And then as you can see right here, I sold the 200 strike put option and did so for a credit of $665. So Netflix has come down a bit more since I made that trade. And that's why the price of this option has increased by a little bit so far. But the trade itself literally is as simple as that. Just a simple put option there. And like I mentioned, I'll be using the wheel strategy. So basically, if by the expiration date, if this option here expires worthless, then great. I'll sell another put option, probably somewhere around the 30 delta, and just keep collecting more and more credit for doing so. Now, if and when Netflix actually does expire below my put strike here, and I'll get assigned on the put option as a result, what's going to happen there is I'll have to purchase 100 shares of Netflix at the strike price, and then I can just hold those shares for the long term. But when that happens, I will also pair that long stock with a short call option, or basically a cover call option. And once more, that would allow me to continually collect more and more credit with each expiration cycle. So ultimately, the wheel strategy here is mostly a bullish strategy, and that makes sense because Netflix has come down by so much, and I am pretty bullish on the stock at this point. But you can also definitely make money with this approach if the stock simply trades sideways or perhaps even moves down a little bit as well. And again, the reason for that is because I'm always collecting some sort of credit by selling put options or call options. And also, of course, as these trades do play out and as different kinds of situations do come up, I'll be showing you exactly how I'm managing everything in these live trading videos going forward. But now, why exactly did I choose to use the wheel strategy here over anything else, like perhaps just buying shares of stock or using a poor man's cover call or a regular cover call, things like that? Well, first off, let's come back to the charts real quick and then come down here and take a look at the implied volatility for Netflix. So I'll expand this chart a little bit. And as you can see, the implied volatility for Netflix is still very, very high right now. In fact, currently, this is the highest it's been over the past 1 year, right? So we're seeing an IV rank of 93% and an IV percentile of 99%. And this makes sense because of two reasons. Number one, leading into an earnings announcement, you almost always see an expansion of implied volatility. And then number two, if the stock does make a massive, massive move, which in this case it did, you might see an even further expansion or perhaps at least the implied volatility staying elevated. And for those of you who are not aware, implied volatility is basically a measurement of uncertainty about, in this case, Netflix's future. And the most important thing to understand is that this number is baked into the prices of option contracts. And so with greater uncertainty or higher levels of implied volatility, you're going to have more expensive option prices. And then conversely, when implied volatility comes down and there's more certainty about the stock's future, you're going to have much cheaper option prices. Moreover, the vast majority of the time when implied volatility expands, typically what you will see soon afterward is a contraction, right? You can see that here, an expansion and then a contraction, expansion, contraction, expansion, contraction, over and over and over again. So therefore, if right now the options on Netflix are basically the most expensive they've ever been in the past year, then there's a pretty good chance that whenever Netflix does stabilize a bit, which likely will happen pretty soon, that implied volatility will come back down significantly and also bring down option prices along with it. So ultimately that means right now I don't want to be buying any options on Netflix because even if the stock does recover, if I bought a call option, let's say, and Netflix does increase in price a little bit, well, the contraction of implied volatility that will come with that is going to significantly reduce the price of my call option. So again, even if Netflix does increase in price a little bit from here, I might still be down money on a long option. And so in particular, that's why I did not choose to trade a poor man's cover call on Netflix. So even though I'm bullish on the stock for the long term and a poor man's cover call would be a good possible option for that, but because that strategy involves buying options, that's why I wanted to avoid that. But then what about a regular cover call, right? I could simply buy 100 shares of Netflix here and sell a call option. And through doing that, take advantage of the high implied volatility and the high price I could sell that call option for. And so the reason why I chose not to do that one either is because this is only the first day after that disastrous earnings announcement. And perhaps Netflix could see a lot more downside in the very short term. So basically, before I get outright long on Netflix by owning 100 shares of stock, I do want to pace myself a little bit and see what happens to this stock over the coming few weeks here. And that's why I sold a put option with an even lower strike than where Netflix is actually trading. And so by selling a put option with a 200 strike, I definitely would be okay at that point. If Netflix came down to that price by the expiration date and I got a sign on the contract, I would be okay owning 100 shares of Netflix at $200 per share. So even after the stock has dropped already by about 35% today, Netflix could still see another 10% of downside before I would get assigned on the contract. And regardless of whether that happens or not, I will still get to walk away and keep the full $665 in premium for selling that put option. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.